Hello, everyone. Welcome. Thank you for being here for today's conversation with Horizon Investments. Always appreciate you taking the time out of your day to listen to us. And of course, if you're listening to this after the fact, we appreciate you taking that time to do so as well. Had a really wonderful suggestion from some clients in the past, which the suggestion was to give some idea of what the topics would be during the conversation and about how much time we're going to spend on each topic. So again, if you're listening after we record this or after the fact, then you'll be able to fast forward through some of the topics that you may not want to listen to or piecemeal listen. So today we have with us again, Austin Fitch. He is the head of portfolio strategy group at Horizon Investments. He is a chartered financial analyst. He's been with us several times. We always appreciate his input, his commentary, and of course, his expertise and wit and charm as part of these conversations. Also joining us today, we have Alina Akram. She is the Tranquilli Financial Advisor Communications Intern. She's been with us for a few months now. I'm very happy to bring Alina in as part of the conversation today and introduce her to all of you formally. I know you've received emails from her. That's how you were invited to this webinar. You'll receive the follow-up with the recording of this webinar from Alina as well. I appreciate everyone who responded to her to schedule meetings and of course to answer the Tranquilli Financial Advisor 2021 client survey. We also have Andrew Polzin, who is the Tranquilli Financial Advisor finance intern. He is a student at the University of Wisconsin in Madison. He's a certified financial planner candidate, and he is studying financial planning at the University of Wisconsin. You could also be receiving emails from Andrew moving forward as he presents some financial planning thoughts, ideas, along with me and Brian Bell, the financial planner that I work alongside on your behalf. So with all of that, we are going to talk 2021 market outlook moving forward with Austin, but I do have to get to the disclosure, which just takes me a moment to read. I think I'm getting pretty good at reading these now. So you can see in bold letters there, disclosure. This webinar is created in August of 2021 and is provided by Horizon Investments and Tranquilli Financial Advisor for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon and Tranquilli Financial Advisor reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessment or investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort level and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and comprehensiveness and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee, in bold letters, against loss or decline in the value of your portfolio. It is an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have Risk Assist feature. While Risk Assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that Risk Assist will always limit drawdown as designed. Accounts with Risk Assist are not fully protected against loss. Thank you for that disclosure availability, Austin. And today's topics. I'll go through this slowly again for those listening after we record this. Stimulus or not, we're going to spend a few minutes talking about stimulus. We'll then switch over in about 10 minutes or so to inflation remains top of mind. We'll spend approximately 10 minutes on that. Employment picture continues to evolve. We'll spend another 10 minutes or so there. the rise of the Delta variant. We'll try not to spend a whole lot of time on COVID, but we'll take 5 minutes or so to speak about the Delta variant and its impact. Another 10 minutes or so on the housing market, which is on a tear, as Austin has put on today's topics. Then we'll jump into socially responsible investing for approximately another 10 minutes, something that we asked as part of our 2021 client survey and appreciated your replies on that. And then new investors entering the market will finish out the conversation, something that I do think is important for you as clients to hear how the next generations of investors are impacting today's current environment. So with all of that out of the way, let me welcome Austin. Thank you again, Austin, for being here. Always a pleasure to have a conversation with you. We're going to let Alina and Andrew hang out for a while with us, and then we'll get to some questions that we know that they have a little bit later on. But Austin, welcome back, and thank you again for being here.
Absolutely. Thanks for having me, Lou, and excited to be back. And hopefully folks find our conversations, as you said, entertaining, but also enlightening. I know we're covering a number of topics today that are probably top of mind to folks. So let's get into it.
We'll do it. And now, before we get there, your new title as Head of Portfolio Strategy Group. Please explain what that means, because that is a new title from when we started these conversations a year ago.
It is. Yeah. So at Horizon, we've got an investment team of 18 individuals, and we break it down into kind of sub teams, if you will. And the Portfolio Strategy Group is a team of folks. So there's 4 of us on that team, 4 CFAs, where we're focused on customized portfolio solutions. So building unique solutions for the advisors and the firms that we're working with for a lot of what we're talking about here today, stuff that's unique to the marketplace. We're not building cookie cutter solutions. We're really building strategies and portfolios that are built for a changing and dynamic market, incorporating other managers where it makes sense, incorporating other types of strategies outside of Horizon strategies. Because believe it or not, there are lots of great money managers and strategy types in the marketplace. I would like to say Horizon has some very good strategies for sure, but there are other strategists and portfolios out there that can absolutely be an important part of these portfolios. So incorporating those into an advisor's portfolio that they're then offering clients is extremely important for us. To truly be able to empower those advisors when working with those clients. So that's kind of the definition of that role, and that the group that I head up is really one focused on those customized solutions.
Well, and as I mentioned to you before we get started, we are taking full responsibility for that new title because you've earned it since we started recording these videos. So you're welcome is what I'm getting at. So let's jump into it. So stimulus or not, please lead us off on the stimulus package, the latest over $1 trillion again. That is will in air quotes say approved, but is it actually going to be approved, and what comes after it? What does it mean to markets? What does it mean to Horizon Investments to have all of this additional liquidity reach us as investors, as consumers?
Yeah, no, that's a great question, Lou. And again, for anybody that's been reading the news or watching any of the news, news channels, there's been, it seems like nonstop talk around this infrastructure package, and we can call it stimulus, you can call it an infrastructure bill. But at the end of the day, it's really an infusion of capital over and above what has already been provided from the government and from the Fed. And I think, Lou, to your point, understanding the dynamics of that bill are extremely important. I think it's maybe a little bit more non-traditional in terms of an infrastructure package because it goes over and above what is normally considered infrastructure. So it's not just roads and transportation, as folks maybe would have otherwise believed from a historical standpoint. It also includes, there's a heavy technology component. There's even been discussion around, whether there can be support for, what we're calling infrastructure, but human infrastructure. So I think there are lots of things to think about in terms of the dynamics of this bill that's being discussed. But as I mentioned, really just this idea of an infusion of capital is extremely positive for the economy short term. And I say short term being that, the ability of the government to drive demand to some extent really is something that, continues to propel the economy forward from our perspective. Again, in the near term, I think there absolutely can be, and probably for that matter will be, longer term impacts of government spending like we've seen over the last 18 months. But then additionally, what we're expecting to see as we get into the fall with this bill, that can have many consequences around government policy in the future. That can have consequences around tax policy in the future. That can have consequences when it comes to Social Security and benefits provided by the government in the future, and maybe the ability or inability to fund those. I think those are all down the road problems for us. What you're seeing from a market standpoint is a stimulus of this nature, an infrastructure focused bill is one that absolutely would provide a tailwind to an economy that's already chugging along quite nicely on the back end of what was, I think we would all agree, one of the quickest recessions, but also one of the deeper recessions that we've experienced in some time. So I think it's a really interesting dynamic to see additional government monies being pushed into the system for the remainder of 2021. But like I said, I think it's absolutely something that's helpful in the short term. The effects longer term, or even for that matter, medium term, as we get out into the mid 2020s, I think is up for debate, is maybe the nicest way to put it. But I think it's important to realize, and for folks on the call may or may not have heard this statement, but it's this idea of don't fight the Fed or don't fight stimulus that's being pushed into the economy, because at the end of the day, we can have a debate over whether or not this is being fiscally responsible from a country standpoint. That's something that's a much longer term issue. I think what we expect to see from Horizon's standpoint is that over the next, call it 6, 9, 12 months, that this additional influx of capital is actually positive for the economy in the short term.
All right, and I do have a question on that. How long? What is the impact? Let's take all the delay out. So a package is passed. It's $1 trillion. It's a stimulus, if you want to call it that. I don't know that at this point it is a stimulus. I think at this point it's just flooding more cash into the system.
Right.
But whatever. That's semantics or a syntax, use of syntax. So $1 billion is approved, reaches the economy. So we'll leave the delay out from the time it's approved to when the money actually reaches. How long does that money work through the system, in your estimation, as an analyst for investment? So $1 billion reaches the U.S. economy. How long does that impact last for the stock market or the bond market, as an example?
Yeah, so I would maybe even put a fine point on that too, to say that the amount of time that it takes to reach the economy is actually even different than the amount of time that the market would react to it, right? So in our view, kind of a market reaction and a market impact is going to be somewhere in the ballpark of 6, 9, maybe 12 months. I would tell you from an actual economy standpoint, it'll take over a year at least for all of that money to get in, if not 18 months to 2 years. In terms of capital infusion, reaching, whatever projects are being funded. And many of those projects, they may be funded, but they may actually not start for another year or two after that. So the impact economically is actually much longer. I think that's where, if you look back at some of the stimulus monies that were put in last year, I think that's part of the argument of, do we even need more stimulus, to your point, Lou, and whether or not you even call this a stimulus. I think what you see from an economy standpoint last year, trillions of dollars flooded the system. You're probably not using all of that capital for 3, 4, 5 years. So this would just add on to that. There's potentially some overlap, right? Because there are different types of projects that, this bill would specifically focus on versus, what we saw from a stimulus standpoint last year. But again, it's not an immediate impact. It's not like $1 trillion comes to be and all of a sudden all of these projects start up tomorrow. Again, the market's going to anticipate. The market is a forward-looking kind of discounting mechanism, if you will. So it's going to act quicker. It's going to react quicker, but it's still not going to be immediate. It's going to be something that plays out over, like I said, 6, 9, maybe 12 months from a market standpoint, but plays out over a much longer term from an economy standpoint.
Okay, and we'll wrap it up there on stimulus and get to the inflation. I just want to say that as someone who lives in New Jersey, and I see some of the names on here, we're all hoping the money drops quickly and gets on our roads, because I had to take my tires off my car and replace them with different tires because I was tired of getting flats on highways. So anyway, we'd like for that to reach our roads and bridges quickly. Inflation. So of course this leads right into inflation, which remains top of mind. We had a conversation last time we were recording one of our webinars here and talked about inflation. I said that I had a thought process on it, that it's been, inflation has been right under our nose for better than a decade, because any trip to the grocery store or the gas pump or even to buy a new car, you've certainly realized what inflation looks like. Why is it still top of mind? How do you react to the thought process that this may be a temporary spike? That's the word from the Federal Reserve. This is a temporary spike of inflation. How do you factor that in, and thoughts on that?
No, I think that's another kind of, like you said, topic that is absolutely top of mind and is getting a lot of press. And I think you've heard temporary, you've heard transitory. There's a number of words that have been thrown around. And I think from our perspective right now, that is a fair characterization. And I think for everybody on this call, you've absolutely seen segments of the economy where you've seen, in some cases, very real inflation. Let's talk about lumber prices. Let's talk about semiconductors. You can talk about a number of different things. Prices for rental cars. We're going to talk about housing prices here in a few minutes. What I would tell you is what we see and what's being characterized as temporary inflation or transitory inflation right now is truly more of a bottleneck, if you will, from an economy that's reopening. I think what we've learned as a country, and for that matter as a global economy, is it's actually not terribly difficult functionally to shut down an economy, right? I'm not saying that there aren't consequences and there aren't challenges when you do that, but shutting down an economy, basically, not allowing for in-person dining or not allowing for in-person, stores to be open, it's actually fairly easy from a function standpoint. What we're also learning is it's much more difficult to reopen that economy, right? Because what you're seeing is when you shut down an economy, well, all of a sudden production goes offline, which then requires companies to start to draw down on inventories. Now, fast forward, when you open the economy, well, the demand doesn't slowly pick back up. The demand goes all the way, goes from 0 to 100, or maybe it wasn't at 0, it maybe goes from 30% to 100 very quickly. Well, if the supply side of that equation is not prepared to also ramp back up from 30 to 100 at that same speed, all of a sudden you have bottlenecks. Again, I gave the example of lumber. We've all probably seen or heard, and I would tell you internally we've learned as much, if not more, than any of us care to ever know about lumber markets. Just as an example of a bottleneck. You saw lumber prices quadruple over the course of like 3 months, right? So to suggest that there is inflation is absolutely fair. But I would tell you what we're seeing in terms of that being a longer term impact isn't really the case. And that's part of why you're hearing this temporary or transitory, verbiage being used. We think the bottlenecks truly start to play through the economy and they start to unwind. You actually seen it in lumber prices, right? You're back today to where lumber prices were over a year ago. That would tell you that this bottleneck or this bubble, if you will, was very short-lived, and it was truly kind of the supply and demand dynamics kind of coming to grips with a reopening economy. Now, go ahead, Lou.
Well, I was just going to say lumber, it leads to other, I've read recently that as expensive as you think cars may be right now, they're only going to become more expensive because of parts. We talked a while back about semiconductors, computer chips, as part of the narrowing supply chain. How is that impacting other parts of what you're looking at? And even if you don't mind, give us an idea of where that leads you from an analytical standpoint to start investing or thinking about this.
No, for sure. So I would say you're absolutely right. There's kind of this domino effect, right? So if semiconductors have a bottleneck, or there's a bottleneck in the production process of semiconductors, to your point, car prices are going to go up until that bottleneck works through, which is then going to create some sort of bottleneck or inflation, temporary inflation from a car price standpoint, right? And again, it flows through to all different segments of the economy. Now, I will say we view that as, and when the Fed says temporary, I think we would call that kind of short to medium term. It probably plays out in terms of those bottlenecks unwinding across the global economy, let's call it over the next year or so. Now, longer term, we don't think those bottlenecks necessarily drive inflation. We think what drives inflation long term, and I would tell you that the data would suggest this historically, what drives inflation long term is wages. And I know we're going to talk about the employment picture here in just a second, but the idea that you have to pay your workers more is truly what drives inflation longer term. Right now, you haven't necessarily seen much wage inflation. And the reason for that, I should step back. The reason that wages drive inflation longer term is if you look at any company really out there today, wages make up 60 to 70% of their costs. So if you get wage inflation, by definition, you tend to get inflation across the board. So that's what we're watching for longer term, which then affects, Lou, to your point, decisions from a portfolio management standpoint, right? In a period of inflation, especially with low interest rates, makes it very difficult for bonds or fixed income to be an attractive option. I would tell you equities oftentimes are going to be the balancing force for somebody's portfolio in a period of inflation. The challenge being that you have to be able to withstand the additional volatility that comes with that. I think we even maybe had this conversation last time we were together. There are times when there are products and strategies out there where you can maybe get more equity exposure, but you can do it in a risk mitigated fashion. So that's one possibility for folks that you're looking for a strategy or a portfolio that is going to deal with inflation better than a bond portfolio that once you consider inflation, all of a sudden you're getting a negative real return. And equities are, like I said, the great equalizer there, but you have to do it in an intelligent way, especially from a financial planning standpoint, so that you're considering the risk, and not just the return. So that's kind of the biggest takeaway for us from a portfolio construction or an investment management standpoint, is to understand we can't just blindly increase equity exposure. You can't go from 50% of your portfolios being invested in stocks to 80% of your portfolio being invested in stocks without realizing that there is a risk side of that that's going to have an effect, right? So doing it in some sort of way that's managing that risk or mitigating that risk of some of the equity and stock exposure is extremely important in our minds.
Well, and I do want to jump in on that and just state that that's where we get into the not specific advice to anyone listening now or in the future. However, Austin, if I can just summarize that, it really is just a statement of because the stock market looks so attractive from a return standpoint, that doesn't mean you just automatically jump into the stock market. There has to be a thoughtful process of how we're accepting the fact that while we may not want to take on the interest rate risk of bonds, that doesn't automatically mean we can, with reckless abandon, simply invest in stocks. There has to be some method of operation, if you will, approach to taking on that additional risk, which
you're absolutely right, Lou.
All right, which leads us into the employment picture continuing to evolve. It leads us into higher wages. I've already had 2 emails from Alina and Andrew asking for a raise during your conversation there, so thanks for that. I'm just kidding, because we pay our interns here. So anyway, the employment picture, it is, I find it actually to be one of the newer lessons for me, 30 years of this work. The conversation of employment, the restaurant, the service industry, continuing to talk about the lack of available workforce. Is that going to have an impact on each of the different levels of employment that are out there from a cost standpoint? I mean, obviously, we need people to work at the places that we need services from. We have to pay them. How does that impact all the way along the employment chain, if you will?
Yeah, no, I mean, it's a great point. And what I would tell you is, I mean, we're having this conversation, which is really interesting, right? Because it's not that jobs aren't available. If you look at the data, it's actually, if you want a job today, it is the easiest market to get a job in the last over 20 years, right? If you want a job, you can absolutely get a job. I think what we're learning, or what we're seeing, is that right now, people don't necessarily want the jobs. So then the question is, well, why don't they want it? I think first and foremost, what you've seen from and we talk, I mean, this ties back into some of the stimulus conversation for that matter, is being part of that stimulus was this concept of additional unemployment insurance or unemployment benefits. So for folks that are not working and are on unemployment, the government came out last year and said, hey, we will provide additional monies on a weekly basis to subsidize, what you otherwise would have been making. And very important, right? Because many of the folks that lost jobs last year were your lower earners, your lower income individuals, folks that are working many of those hourly jobs in the economy. Absolutely a segment of the population that probably needed that bridge loan to some extent of what it really was. What you're finding, though, now is the economy's trying to open back up, but those benefits are still available, and they're not available in every state. Certain states have started to decline those additional unemployment benefits, but they don't fully run out in terms of the additional benefits until September. So we still have another month to go in terms of what we're seeing there. And if you look at data, like we ran it on our side, you can, as a fully unemployed individual, on average across the country, so it varies state by state because different states pay different rates of their traditional unemployment. But on average, you can make over $35,000 a year being fully unemployed with those additional unemployment benefits. Now, again, remember, you also have health insurance through Medicaid in that scenario. So then the question becomes, what's the marginal amount of money that I have to earn to get me off the sidelines so that I go from working 0 days a week and earning $35,000 to earning, $40,000? Is the marginal $5,000 enough to get you off the sidelines and work 40 hours a week? Probably not. If you look at those average, those hourly earners, right, the lower income individuals where much of this is supporting them, they're probably not going to make $40,000 a year to begin with. And if they do, it's because they're working 40, 45, 50, 60 hours a week. So we're in this period, this kind of period of this interim tension, if you will, where we're still waiting on the additional unemployment benefits to run out. And you still have a need for employment. I think going back to this wage inflation conversation, you have yet to see significant wage inflation. Unfortunately, you've just seen companies, unwilling to hire individuals at higher price points because they believe, and I think we would agree with this here at Horizon, that a month and a half from now, when those additional unemployment benefits run out, and all of a sudden you go from making $35,000 a year on unemployment to 15, well, all of a sudden there's a much greater incentive to go back to work, right? That marginal difference between going back to work and remaining unemployed is very different. We think that changes the game. We think that incentive structure being in place or being put back in place, I guess you should say, as we get into September, will have a pretty meaningful impact. And that's what we're watching for as we get into the fall is does that incentive structure start to kick in or kick back in, I should say. If for some reason it didn't, then I think you're at risk of wage inflation being a longer term issue for the economy. But between now and for the next month or so, we're kind of in a holding pattern. Again, the good news from a wage inflation standpoint is that companies have not across the board began hiking interest rates. They're waiting that out. Now, some of them are offering bonuses. They're offering one-time payments to get folks back to work. But you haven't seen, for example, your fast food restaurants hike wages by 20, 30, 40% to get folks back in the building. They're just operating a much leaner business at this point. And again, I think we can all make comments about the challenges that is creating for the consumer. But I think that's something that does start to work its way out as we get later in the fall.
Okay. And on that point, it's anecdotal, but I've been to, if you see me drinking a Dunkin' Donuts, I've been to multiple Dunkin' Donut locations that are closed at 3 o'clock because they do not have employees for a later shift, which I just, it upsets me, I'll say, for everyone. I want those people to be working. I know in my case, the jobs that I started at led me to where I am now. So I respect that part of the hard work and the, if you will, education that those initial jobs provided to get me to look to continue to move through the employment chain or the work chain. So the rise of the Delta variant, we have to jump to that. We're at about 33 minutes. We try to keep these around 45 to 50 minutes, and we're going to try to do the same. And I did not offer Alina and Andrew the opportunity to jump in at any point. So of course, Alina and Andrew, at any point when you have a question on any of the topics remaining, please just jump in. The rise of the Delta variant, Austin, right away when COVID-19 arrived, if you will, early in 2020. Obviously it's COVID-19, so it started before then. But we jumped right on these webinars and started having a conversation about it. Now here we are, 20 months later, if you will, and we're still speaking about it and its impact, and we have a whole new variant. Please share with everyone in a few minutes how Horizon views this latest challenge. And I do just want to mention that a while back, if anyone's a sports fan, the New York Yankees had, I want to say, 8 vaccinated players that contracted COVID. This is going back a few months, and there was a lot of question as to how could that happen. I don't know that it was the Delta variant, but certainly signs of things to come. How do we handle this moving forward? How do you handle it? I don't think you're suggesting a shutdown of the economy. So what are you suggesting as the impact to markets overall?
Yeah, no, I will say, Lou, I think that's the good news is from everything that we've seen data-wise and even anecdotally is that we're really realistically at this point, specifically with the Delta variant, not looking at large scale, economic shutdowns or shutdowns and lockdowns really around the world. You've seen maybe a little bit more out of Europe and or Asia in terms of kind of a lockdown approach. But what I would tell you, and a lot of people don't realize this just because of the coverage that we get domestically around the vaccine conversation, is the U.S. far and away is in a better place than probably anywhere else in the world when it comes to vaccines. So that actually helps our economy in terms of handling the Delta variant when it comes to lockdowns. Now, we're not going to have a conversation about whether the vaccine is a good or bad idea by any stretch. But what I would tell you is, from an economic policy or from a government policy perspective, in regards to shutting down or locking down portions of the economy, their willingness to do that is a lot lower if you have higher vaccination rates. So for the U.S.'s sake, where we're pushing 60-70% of folks that are eligible for the vaccine, like I said, we're far and away one of the leaders globally. An example was given just the other day. Everybody's making a big deal out of the Olympics in Japan. And again, us in the U.S. look at it as like, well, you've had the vaccine available. Probably a majority of the population is vaccinated. Why are they making such a big deal of fans at the Olympics, for example? Well, the difference that we don't get the news of here in the U.S. is in Japan, only roughly 10% of individuals eligible for the vaccine have actually been vaccinated. It's a much different environment. It makes a lot more sense why they're restricting travel, while they're locking down, portions of the economic or of the Olympic Village, as opposed to the conversations we're having. So again, I would say, not politically right or wrong, we're not going to have a conversation around vaccines, but the good news is where we stand in the U.S. helps us from an economic perspective. I would tell you the one thing we are watching when it comes to the Delta variant is the impact that it has on schools and in-person learning as we get into the fall. That's an area of the current population where, currently many of those kids are not eligible. And the consequences of that, what we found is, school, right, wrong, or indifferent, for many folks serves as childcare. And an inability to send kids back to school in the fall, we think actually could have some pretty serious economic impacts in terms of the continued trajectory of the economy. Now, at this point, good news, we haven't seen that really anywhere in the U.S. in terms of in-person learning kind of not being an option. Still appears to be an option really across the board in the U.S. We think that continues to be a positive. Now, again, you're going to get flare-ups here and there within the U.S. from a virus standpoint, whether it's the Delta variant or any future variants. But at this point, you're not seeing the risk that we saw last year of economic shutdowns and of significant or severe economic headwinds because of this. Now, it's absolutely going to have an impact, personally for individuals, and not to downplay that. But I think it's important to understand the economic impact maybe not being as big as, not being anywhere near as big as what we saw last year.
All right. And on that, just two things. Yesterday, my youngest son, Jack, is headed to the Ohio State University. I've been corrected by him more than once for Ohio State. It's the Ohio State University. He's headed there in the fall, and he let me know that one of his classes has now been moved online, which he was not expecting. So that's the first, if you will, shoe to drop there. He's hopeful that the remainder of the classes will be in person. He's really looking forward to that. He spent his freshman year online, looking to be in class. So hopefully, as a nation, we are far enough ahead. Now, if you read the New York Times and the Wall Street Journal like I do each day, you wouldn't actually take that out of those two publications. You would think we were doing a terrible job versus, and I shouldn't say versus, but as compared to the remainder of the world. Now, I do have this question for you in talking about the Delta variant, and it's purely a prediction on your part, and it's way forward looking, but everyone's waiting for me to waited on the edge of their seat for your answer. Do you think that the U.S. economy would ever be shut down again the way that it was during the initial COVID?
I hesitate to say never, but assuming that we do have the vaccines, like for example in COVID, we do have a vaccine that seems to be working right now against really any variant that has formed so far. Knowing what we know now about the different variants, I think it's going to be very difficult. I think to the conversation earlier, we've realized the impact that has, not just in the period when the economy is shut down, which we all lived through that. We saw what that did to a number of folks, but now we're experiencing the fits and starts of restarting an economy. And I think you're realizing it's actually pretty easy to shut it down. It becomes a lot more difficult to fire it back up.
We talked about that a long time ago. We did talk about the challenge of restarting. So, let's keep moving forward here to the housing market being on a tear. Interest rates are low. Stock market is high. Jobs market. We touched on the wages, but we also mentioned that it's hard to even find employees to go to work. Housing market is on a tear. I know in the selling of my home, it was approximately 30% higher than I would have sold it for just 12 months earlier. That seems to be going on throughout the U.S. How long does it stay on a tear?
Yeah, I think that's absolutely a fair question. I think what we're looking at probably puts it on this trajectory maybe for another couple months. We don't think this is something that persists for a long period of time. Now, I will tell you, we don't believe that it's a bubble. We don't think that housing prices pop and all of a sudden your house that was worth $500,000 is only worth $250,000. I think we're of the mindset that in most marketplaces, now obviously there are going to be specific segments around the country, but in most marketplaces, what we've seen is a run up, and then you're going to get more of this plateau effect or a cooling of the growth from a price standpoint. I think that's something that plays out, call it over the next couple years in terms of that plateauing or slowing of growth. But I think you absolutely get maybe another couple months of kind of the tear that we've been on. Part of that comes, right, because interest rates are so low, folks can buy more house, but I think that's something that's really important to think about for sure.
All right. And then when I started this work, it was the 88 to 92 housing market meltdown. I've said consistently, I've said it on these recordings a few times, that's still the worst I've ever seen. I think actually, Austin, I brought it up that one time. I said, you might not have been born at that point. So I can't help but kid around with you a little bit because you're so good at this. But the current environment it reminds me of the lead up to that. And I've read reports. I get a weekly report here in New Jersey on the housing market, and it covers some national news or thoughts on housing. The last one I read said that we were short by 5.2 million homes in the U.S. of what will be needed. This advisor's concern is that we hurry up and build those homes, and leading right into what ultimately does become a bubble. So I'm hopeful that that's not the case, but we've seen this movie before kind of thing. So I would like to jump to socially responsible investing. I think this is a topic that, again, something that you put up the slide ESG, and that's environmental social governance, correct? So socially responsible investing has become more mainstream, we'll call it. A few years ago, it was more of a buzzword within investing. At this point, now you said you're looking outside of Horizon Investments to other investment firms that you're working with? Are you including them in your portfolios if they're socially responsible investing? I'd like to ask you to just give us a brief definition of ESG and how Horizon is looking at the possibility of including this in portfolios.
Yeah, I think that's absolutely a good place to start. What I would tell you is this idea of ESG, or socially responsible investing, is one where you're trying to not just do well with your investments, but you're attempting to do good, and maybe and do good, on your personal beliefs, if you will. What I would tell you is at Horizon, we've done a lot of research on this over the last, call it 18 months at this point. And we find it extremely, extremely important to understand the different types of socially responsible investing that are available. I think what you've seen is that historically ESG, or socially responsible investing, maybe got a bad rap to some extent because they did what was called exclusive screening, and they screened out any company or companies that violated whatever parameters you were setting in that portfolio. What ended up happening was you actually screened out a lot of companies that actually still did really well from an investment performance standpoint, but did not meet every single criteria from a socially responsible or an environmental or social governance perspective. I think it's important then to understand that there has been a development over the last, let's call it 2 or 3 years, where you've seen what they're calling inclusive socially responsible screens. And that's where you don't necessarily completely remove companies that aren't perfect. What you're doing is maybe you're dinging them from a weight in the portfolio. Maybe instead of 10%, now they're only 5% of the portfolio. But an inclusive screen still allows for many of the companies that are more broadly in the universe to exist in those portfolios. The weighting mechanism, or the size with which they're in the portfolio, is a little bit different. So what you found more recently with some of those ESG or socially responsible managers or portfolios is an inclusive screen has actually proven to filter out maybe a little bit more of the companies on the fringes, but still gives you a very similar experience to a market of future growth potential. Whereas we used to screen a lot of that out with that restrictive screen and exclusive screen. That again, ESG kind of got a bad rap because it started in that camp, but it's adapted to some extent. And I think it's absolutely something that folks that are thinking about investing for the future, at least it's worth a thought today, whereas 5 years ago, it was maybe something that was maybe a little bit more prohibitive from an investment return perspective.
Andrew, you had a question for us?
Yeah, jumping off, I know you talked about the screening process, but going forward, how do you see this market evolving for investors?
Yeah, no, Andrew, that's a great question. I think here at Horizon, what we would say is ESG, or socially responsible, is absolutely kind of what we would call an emerging factor. And what it means by that is this screening mechanism is really allowing managers to identify companies that are maybe a little bit more forward thinking. And again, you're not dinging them, or you're not removing them for not being perfect, because we all know that both individually and corporation, as a corporation, nobody's perfect. But what you see with kind of the impacts going forward is if you're screening for companies that are maybe more socially responsible, or for that matter, have stronger corporate governance, you tend to have stronger balance sheets. You tend to be a little bit more innovative. Maybe you tend to have better stability from a financial perspective. Whereas companies that have, let's just use corporate governance as the example, that are taking more risk there, are going to be your Enrons of the world, or your WorldComs, that are going to play a little bit more fast and loose. Yes, you may get a higher return at a given point in time. You also may have more risk of defaults and challenges from a balance sheet perspective too. So great question, Andrew.
It is a great question. And if I can just jump up, the 5 years ago that you were talking about, Austin, the question always would come up, well, do they make money? And now I think with the evolution that you're talking about, what Andrew just asked about, we've seen that evolution to this point where Andrew can ask about socially responsible and actually expect some kind of return out of it because of the changes. So, which leads us to the new investors who it's not a new statement. The future belongs to the young. That's all there is to it. So here we have them. Here we have the conversation of new investors. Robinhood, which we've talked about in the past, just went with their initial public offering. A lot of people want to say, well, it didn't go well. I don't know. 10 billion net worth doesn't seem like it went poorly. That's for sure. So it just isn't 20 billion. So the question, Austin, becomes new investors entering the market. That leads to more investment. I mean, obviously that's a simplified comment, but it is day to day, if you will. The retail investor is becoming a bigger part of the day-to-day market. Whereas go back to the 70s, even into the 80s, it was institutional money managers and pensions. Moved from the 80s into the 90s, 401k, your day-to-day investor. From the 90s, the 2000s and forward that we're in now, online trading, applications, apps that you can trade with. So tell us about new investors, how you view that at Horizon and their impact on the markets.
Yeah, I mean, Lou, you brought up a great point. Whether it's Robinhood or any other app that's available on a phone that you can trade stocks or bonds, or shoot, for that matter, you can trade options and futures and all kinds of stuff through a couple clicks on a phone. It is absolutely seems to be the way of the future from a technology standpoint, which the access that it's provided, and I think you just made the point too, if you look at the amount of dollars that are being traded today and the percentage of those dollars that are made up by retail investors, it's as big as it's ever been. And we don't think that trend necessarily slows down anytime soon. So I think that's something that we're continuing to learn, and, as we go to some extent. But it's important to understand the dynamics between a retail investor and an institution, or a retail investor and a 401k investor, and for that matter, maybe a younger investor and somebody who's maybe a little bit more seasoned or has invested a little bit longer. And I think what you learn is that the retail money is a lot more mobile, that it can shift very quickly. And because of that, what you see is a different marketplace today than you saw, for that matter, even 5 or 10 years ago. So I think understanding those changing dynamics is really important.
And I think that's where Alina has a question on that for us.
Yeah, so what is the impact of new investors entering the market through various apps and technologies that were previously unavailable?
Yeah, I mean, that's exactly what we're getting at, Alina. And what I would tell you is, I think the impact, at least what we've seen so far, has been a little bit more volatility. You saw that, for that matter, last year, right? During kind of the COVID crisis, you saw more volatility in the marketplace than we'd ever seen in a market sell-off. For those of us that lived through and participated in, to some extent, the great financial crisis, it was a much different feeling, but a much different environment from a market standpoint, right? It took, for that matter, almost 15 months to go from peak to trough, top to bottom, on the way down. For those of us that then lived through COVID last March, from a market crisis standpoint, we went from top to bottom in 20 market days. That's like it took almost 300 days, which itself was fairly quick if you look historically, to 20 market days. And a lot of that comes from the retail money being a lot more, I'll say, nimble, because they can move much quicker. but also a lot more flighty, right? It may be in one day and out the other, and it moves very differently than institutional money, or for that matter, even someone's 401k, which oftentimes is more of a buy and a longer term hold.
And Austin, with that, we're right at 55 minutes, which again, we took a little extra time today, but I think the new investor entering the market is a great place to close out our conversation today. Let everyone who is listening know that we'll be back on August 20th. We're going to have a conversation with Morningstar Investments, talk some individual stocks during that conversation. But Austin, any final word that you want to put out about this conversation, about looking forward the remainder of 2021 at Horizon Investments?
Yeah, I mean, I think the only other thing that I would say is, and we didn't talk too much about it, but I would say if you look at the outlook for the next 6 months of this year and even into 2022, we touched a little bit on the tailwinds of the economy given the stimulus, but you've got a consumer that's extremely confident right now. You've got folks that actually saved over $3 trillion during the COVID crisis. You've got money that is, unfortunately or fortunately, depending on how you look at it, kind of burning holes in folks' pockets. So this idea that we're at the peak, I don't think is necessarily the case. I think you can make the case that there are going to be headwinds as we get into 22, whether it's policy conversations, whether it's China conversations, whether it's taxes. Those are all problems that probably start to arise a year from now at the earliest. We think for the next, again, 3, 6, 9, 12 months even, you've got a pretty solid runway from an economic perspective and for that matter, from a market perspective.
Outstanding. All right. Well, I want to make sure I say thank you to Alina and Andrew for being a part of this today. Austin, always a pleasure. Thank you so much. Say hello to our good friend Josh Bartholomew there at Horizon and everyone else. Appreciate you, everyone watching. Thank you again, and everyone listening after. Thanks for taking a listen, and we'll talk to you again soon.
Thanks a lot.
Thank you.